Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth, and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, to discuss if the Nasdaq-100 is fairly valued based on historical averages. And Mark, this is when things start to get a bit interesting here, when we've been looking for capitulation, we've been looking for bear market territory. Now the charts are somewhat aligning here. Let's take a look at your first one here and look at historical valuation.
Sure, Jill. Great points there. And as you can see on this first chart, I had to put the PE ratio on its own axis here on the left-hand side of the chart. You can see going back about 20 years to end of year 2001. That's the history of the PE ratio on the Nasdaq-100 index. I get a little irked when I hear people talking about, this is a repeat of 2000 and, the Nasdaq-100 is going to be down 75–80% over the course of 2 years. It's just not at all comparable. I mean, PEs back then, 20 years ago, you could see were over 200. We peaked at just under 40 at year end 2020. And you can see, the current PE is showing at just under 25. That is below the average of the last 10 years. And you can see, looking out 1 year into the future in terms of earnings, we're below 20 in terms of PE on next year's earnings, which are still expected to grow. And what you've had, what we looked at last week was, you've had this weird market dichotomy where all of a sudden these tech companies, a lot of them that are still growing very solidly in terms of top line, in terms of bottom line, are now trading at a discount to consumer staples companies like Kraft, like Pepsi, that are growing in the high single digits and don't have anywhere near the long-term growth potential of some of these big names within the Nasdaq-100. So really any measure you look at in terms of valuation, if you look at price earnings, price sales, EV over EBITDA, or price to cash flow, we are sitting at or below average over the past 10, 15 years. That's where we've gotten so far year to date with these market declines.
And Mark, you can also see in your next chart here when you look at fundamentals.
Yeah, I mean, this is just showing you, the per share growth in sales, earnings, and EBITDA. We were barely producing any earnings 20 years ago. There was a huge earnings recession within tech and impacting the broader Nasdaq-100. There's nothing of the sort expected currently. You can see that, for the following year, 2023, earnings are expected still for the index to grow approximately 10%. That is a far, far cry than the earnings recession you saw 20 years ago. Even though analysts have taken back their estimates a lot this year, given the worries about recession, given the worries about inflation and cutbacks and things like that. The fact is, fundamentally speaking, the companies in this index are still way, way better positioned than they were 20 years ago, and in many respects, better positioned than the broader U.S. large cap market.
Yeah, Mark, I would agree. And we can see on this last chart here, the margins are just so healthy in many of these Nasdaq-100 names. You don't have to deal with razor thin margins, such as you see with consumer companies or other types of sectors as well. I mean, it's right there. Those are healthy margins.
Yeah, that's a great point, Jill. And you kind of saw that this week with, Walmart and Target having their worst single days of performance in, call it 20, 30 years or so. Those types of companies, you're right, they have a lot more competition. They have a lot tighter margins. They have a lot less of a cushion, frankly, to deal with things like inflation eating into margins that they can't pass on to their consumers, as well as, potentially a recession eating away at final demand and lowering their overall net income margins that way. I took a look at something very interesting last night. We have an index within Nasdaq called the Nasdaq Price Setters Index. It selects the 150 highest pricing power companies in the entire U.S. large and mid-cap space of approximately 1,000 companies. So the top 15%, in other words, in terms of pricing power measured on 11 different factors. Guess what percentage of the Nasdaq-100 qualified for that index? How many of the 100 companies qualified?
I would say, if not all of them, certainly over half.
Well, it was about half of the index in terms of index weight, and 29 companies in total. So you would expect, all else equal, 15 of the Nasdaq 100 would qualify, right, to be in line with the rest of the US large and mid cap market. So you had double in terms of punching above its weight of number of companies, and almost half the index by weight qualified for this price setters index. But point here is that if inflation is to be a concern on an ongoing basis, you want to have pricing power. A lot of the companies in the Nasdaq 100 have that. There's no reason it should be underperforming the broader market, but that's what we've seen this year.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Oh.